Hello everyone, welcome back. And it has only been a short stretch since gold and silver gave investors one of the most violent reminders imaginable that the price on a screen and the condition of the physical market are not always telling the same story. It is Tuesday, May 5th, New York time, and before we get into this, write the day and date you are watching from in the comments right now, because I want to know how fresh this message is when it reaches you. And just before we dive in, if you value the work I'm doing here and want more breakdowns like this, subscribe and comment Our John AG. That tells me you're here for the full story, not just the headline. So, jumping in, another week, another round of people telling you that gold and silver are finished, that the move was just hype, that the crash proved the metals trade is broken, and that anyone still holding physical metal is somehow missing the obvious. But this is exactly where most people make the biggest mistake. They look at the fall, they look at the red candles, they look at the panic, and they assume the fundamentals collapsed. And from what I'm seeing, that is not what happened. What happened looks much more like a market plumbing event. Not clean, not calm, not pretty, but also not the kind of event that tells you physical demand disappeared. Based on recently published numbers, the late January and February reversal in gold and silver was amplified by leveraged products, fast money selling, margin pressure, and trend-following models all moving in the same direction at once. That matters, because when a market sells because the structure forces selling, that is very different from a market selling because buyers no longer want the asset. And this is where the story gets interesting. Because when gold and silver were running hard, leveraged funds had to keep adjusting exposure to match their daily targets. That works beautifully on the way up, because buying creates more buying, momentum attracts more momentum, and everyone starts believing the move is effortless. But the second price reverses, the same machine that pushed the market higher starts working in the opposite direction. It has to cut exposure, it has to rebalance, it has to sell into weakness. Then, margin requirements rise. And no, I am not going to repeat the exaggerated claim that margins exploded by some wild multiple. That is not supported by the official notices I reviewed. What is supported is simpler and still important. The cost of holding futures exposure rose materially, especially after volatility surged. And when the collateral bill rises during a falling market, weaker hands do not calmly study fundamentals. They liquidate. So you had leverage selling, you had margin pressure, you had trend models flipping, you had retail money getting squeezed out of products they probably never fully understood. And then you had the most dangerous part of any leveraged market, which is forced selling that creates the conditions for more forced selling. That is why I keep saying the price action alone is not enough. Because while paper traders were being pushed out, physical demand did not vanish. In fact, the opposite showed up in several places. China pulled in unusually large amounts of silver early this year, with imports in the first 2 months already around the high end of anything seen in years, and March coming in at a record-type level. I'm rounding that intentionally because the exact number is less important than the message. The message is that one of the largest physical buyers on Earth did not act like silver had become unwanted, and that creates the disconnect. On one side, you have paper selling. On the other side, you have physical metal moving toward buyers who actually want bars, supply, industrial feedstock, inventory, and optionality. That does not mean price cannot fall. Of course it can, but it does mean the crash should not automatically be read as demand destruction. Now, here is where we need to be careful, because this market attracts a lot of big claims. Some people will tell you every ounce leaving a warehouse proves a secret government operation. Some people will tell you COMEX is the only place in the world where price is made. Some people will take a normal margin change, stretch it until it sounds explosive, and then build an entire theory on top of it. I am not doing that. COMEX matters. It matters a lot. It is one of the main places where futures liquidity concentrates, and futures pricing can absolutely drive short-term behavior. But gold and silver are global markets. London matters. Shanghai matters. Regional premiums matter. Physical flows matter. The idea that one exchange is the entire planet is not analysis. It is oversimplification. And if we are going to take this seriously, we have to separate confirmed pressure from convenient drama. There is a real story inside COMEX and the broader warehouse system. But the story is not that every truck leaving a vault is proof of a mystery buyer. The real story is that delivery interest and warehouse movement have become much more important to watch, because in a tight physical environment, metal that moves from easy exchange liquidity into stronger hands can reduce the cushion available to paper markets later. That does not create an immediate shortage headline every morning, but it changes the character of the market over time. And this is why silver being added to the United States critical minerals list matters more than most people realize. It does not mean the government is secretly buying every bar. It does not prove emergency accumulation. What it does mean is that silver is no longer being treated only like jewelry, coins, or speculation. It is being treated as a material tied to national supply chains, electronics, solar, defense, and industrial resilience. That shift matters because policy attention often follows supply risk. Now think about that next to China's silver appetite. If physical demand is being pulled by industry, retail investment, and supply chain security at the same time, then the paper price can stay volatile while the strategic value of the metal keeps rising. That is the kind of setup where weak hands get shaken out and patient physical buyers quietly improve their position. And gold is sending a similar message, just through a different channel. According to the latest publicly available central bank data, official buyers continued adding gold in the first quarter at a pace around the mid-200s tons. That is not small. And even more importantly, it tells us central banks are not treating gold like a short-term trade. They are treating it like a reserve asset in a world where trust, sanctions risk, currency risk, and debt risk all matter more than they used to. But here again, we need accuracy. France did not simply move every ounce of its gold home in some dramatic overnight repatriation story. The cleaner version is that its central bank replaced and upgraded a little over 100 tons of older, non-standard gold that had been held in New York, while keeping total reserves roughly unchanged. The new bars are held in Paris. That is still important. It still speaks to custody, quality, liquidity, and control. But it is not the cartoon version of the story. And that distinction matters because real facts are already strong enough. We do not need fake exaggeration to make gold and silver interesting. The bigger picture is this. The world is slowly relearning the difference between owning a price exposure and owning an asset. A futures contract can be closed. An ETF can rebalance. A leveraged product can implode. A custodian can add conditions. A broker can change requirements. But a physical bar in direct possession is not someone else's promise in the same way. That does not mean everyone should rush out and put everything into metal. That would be reckless. But it does mean the conversation is changing. For decades, the mainstream portfolio answer was simple: stocks for growth, bonds for safety. But recently, that formula has been under pressure because bonds have not always behaved like a clean shock absorber. When inflation rises, when deficits grow, when long-term rates become unstable, bonds can become part of the problem instead of the protection. That is why large institutions are now talking more openly about alternatives: commodities, cash, and gold. Some are discussing portfolios with less reliance on long-duration bonds. Some are looking at gold as a larger stabilizer. Others are spreading risk across stocks, bonds, cash, and commodities more evenly. I am not saying any one model is perfect. I am saying the old automatic answer is no longer automatic. That is a major change. Because once big money starts admitting that bonds may not always protect purchasing power, gold stops looking like an old-fashioned relic and starts looking like a balance sheet tool. Silver, meanwhile, sits in a different lane. It is monetary, but it is also industrial. That makes it more volatile, but also potentially more explosive when physical demand collides with limited available supply. Now, let me challenge one bullish point because this is important. Not every delivery spike means the system is about to break. Not every premium means the West is losing control tomorrow. And not every bank forecast should be treated like prophecy. Forecasts are marketing, risk management, positioning, and sometimes plain guesswork. The useful signal is not that some institution raised a target. The useful signal is that multiple parts of the market are now discussing gold, commodities, and physical supply in ways that used to be considered fringe. That is the shift. The metal story is no longer just about inflation. It is about debt, it is about collateral, it is about reserve management, it is about supply chains, it is about whether paper claims can keep expanding faster than confidence in the institutions behind them. And this brings us to the Treasury market, which may be the most important part of the entire discussion. Recently, a former Treasury Secretary warned that the United States should have an emergency plan ready in case demand for Treasuries ever weakens in a serious way. Now, that does not mean a crisis is tomorrow morning, but the fact that people at that level are even talking about a contingency plan tells you the risk is no longer something only gold bugs discuss in dark corners of the internet. If Treasury demand weakens, rates can rise. If rates rise too much, deficits become harder to finance. If deficits become harder to finance, policymakers face ugly choices. And in that kind of environment, investors start asking a very simple question: what do I own that is not someone else's liability? That is where gold has always had its role. Silver is different because it carries more industrial risk and more volatility, but it also carries more leverage to physical tightness. Gold is the anchor. Silver is the pressure gauge. When both start behaving strangely, and when physical flows are strong even after price collapses, I pay attention. So what do I think is really happening? I think the crash flushed out leverage. I think it exposed how fragile certain paper products can become when everyone is leaning the same way. I think it gave physical buyers a chance to step in at better prices. And I think it reminded people that in precious metals, the most important question is not always, what is the price today? Sometimes the better question is, who is using this volatility to take control of real metal? Because that is the part that does not show up in a headline right away. A price chart can make you emotional. A warehouse trend can make you curious. A central bank purchase can make you patient. And a margin-driven liquidation can make you realize that a lot of what people call market direction is actually market mechanics wearing a disguise. So, with gold and silver, I continue to separate trading from ownership. If someone wants to trade, there are paper tools for that. But physical metal is a different category. I look at it as financial insurance, purchasing power storage, and a way to stand outside a system that keeps asking for more trust at exactly the moment trust is becoming more expensive. And if you're successful, share your success story in the comments so others can stay motivated. People need to hear from real viewers who prepared, stayed patient, and did not panic just because the screen turned red. As we wrap this up, remember what this market just showed us. Paper selling can be violent. Margin pressure can be brutal. Leveraged products can turn on their holders quickly. But if physical demand remains strong, central banks keep buying, industrial users keep pulling supply, and governments keep treating silver as strategically important, then the story is not over because of one crash. It may actually be entering a more serious phase. So keep your head clear. Do not chase panic. Do not worship forecasts. Do not build your entire view on rumors. Watch confirmed flows. Watch delivery behavior. Watch central bank demand. Watch premiums. Watch Treasury stress. And most importantly, understand why you own what you own. If this breakdown helped you see the difference between paper noise and physical signal, leave a like, subscribe, and share it with someone who still thinks gold and silver are only about price charts. This is for educational purposes only. I'm sharing market analysis and personal interpretation, not telling you what to buy or sell. Your money, your risk, your responsibility. So think carefully before making any financial decision.